Yeah. Let's see if this one works. The last time it didn't. Anyway, in this episode of Bitcoin's mean reversion is a bully. Did you notice the 4 hour time frame that I've been telling you folks was going to mean revert since that little run up it did, and the run up that followed, and the run up that followed that. And I still kept saying it's in mean reversion to the 30-12 RMLR. And it can go up, down, or sideways to do it. And it sure did. Right, it went up and up, and then it went sideways. And it mean reverted to it. And why is that? Why does mean reversion happen so frequently and routinely, like clockwork? Because very simply, returns mean revert. Assets move away from the mean, the mathematical mean, right? And assets move towards the mean, as they revert to the mean. Now, it can be that when they pull away from the mean, that the mean is actually the thing going up or down, away from the returns. It can be the other way around, that the returns are pulling away, going up or down, away from the mean. And the same thing when they revert. Right? It can be that the asset is moving towards the mean, or the mean is moving towards the asset. Of course, both things can be happening at the same time too. Right? They can be moving towards each other, or they can be moving away from each other. Right? In any case, what happens, and the reason that it's so obvious when it's going to start happening, is just straight up math, right? When you look at when the reversions begin to happen, well, you'll find that more often than not, they are confirmed within a couple of candles after they stop banging away at the third standard deviation band of the reverse mean of log returns, otherwise known as the RMLR, right? And that's our handy little indicator that lets you see into the future. What do I mean it lets you see into the future? Well, the alpha trading reverse mean of log returns indicator literally shows you the direction of the future reverse mean of log returns. And it, of course, shows you the current one as well. And it shows you if the current one is moving along in the direction that was predicted, and if it's correlated significantly or not, and if this correlation direction is syncopatico with the expected direction of that RMLR that was predicted, and you'll find that most of the time the prediction of the direction is extremely accurate. And why is that? Well, for various mathematical reasons. Let's just put it this way. Past price action can definitely tell you the future returns, or the future reverse mean of log returns. And, well, we figured that out, so it's a very useful indicator. And what that means is that we have a very good handle on what is likely to happen next. Not just with the RMLR itself, but by looking at the projection boss indicator, which gives you a very nice normal distribution or Laplace distribution probability boss, which is like a projection of the distribution model from the current candle wherever you stick it, looking forward. It can be past candle or the current candle. And normally it's best to stick it on a reversal candle. And the reason for that is because that is where you'll see any kind of changes that are likely. And you can see it very obviously on very high time frames, but you can also see it very nicely on low time frames. And then of course there's such a thing as drift. And drift is basically an indication of the market generally moving along in a moderate upwards direction over a long period of time. And research has found that something like about 80% of all assets over time tend to drift up. Does that mean that all assets or 80% of assets will definitely drift up, over X period of time? No. It means on average, 80% of the assets that are liquid and trading, not the things that are prone to disappearing, right? But the assets that are actually worth trading, drift up over time, over, years. What does that mean? Well, that means that if you put one of these projection devices to project the distribution model that you want to look at into the future, there is a high probability, if you're looking at daily time frames or higher, or even 4-hour time frames or higher, that drift may have an impact. It may be slight, but it will still be an impact. Generally, you can put that drift on and look at it at any time frame, but really anything under 4 hours is kind of, in my opinion, not necessary. You can leave the drift off and see the distribution normally, where the mean is, flat. But again, that's a matter of user preference. Anybody can do what they want with that. In any case, that looking at that distribution model going forward from whatever from whatever candle you set it to, is an extremely effective way of noticing how the asset is traveling through the distribution model. And when you have the RMLR giving you the future RMLR direction, showing you literally what is likely to be the future direction of the RMLR, and you have the central power mean of the UPM. That central power mean of the UPM shows you very much where is the actual mean that the asset is zigzagging around. So you've got the reverse means showing you where the asset is zigzagging around. You've got the regular mean showing you, or the power mean showing you where the asset is, and the returns are zigzagging around that mean. And you've got the distribution model showing you where within or outside of that distribution model the asset is moving. And that tells you very, very easily when you can take moves from the mean, up or down. It tells you very easily when you can take moves from the extremes, like when it reaches a 99.7 probability arc on a projection boss, or when it reaches a third standard deviation band, which is again 99.7% probability that it will not close outside a third standard deviation band, up or down, that it will mean revert once it stops hitting that area, right? And it can go up, down, or sideways to mean revert, and that's why we've seen the asset mean revert so nicely over the last several days or so after it stopped hitting that third band of the RMLR to the upside on the 4-hour time frame. And now we have it happening on the daily time frame, right, where it's just been banging away to the upside, smashing that RMLR band again to the upside. Once it stops doing that, then it will eventually mean revert. When will that happen? Well, once you have a candle that hasn't hit it anymore, it's starting to confirm it, but it hasn't really confirmed it, in my opinion anyway, according to the statistics I've looked at, all the research I've done from the time we discovered this thing. It takes usually 2 candles to basically confirm it. Does it happen sometimes that it can skip 2 candles and then touch it again? It does happen. It's pretty infrequent, but it does happen. But once you got 2 or 3 candles and it hasn't yet fully mean reverted, but it hasn't touched that third band to the upside or the downside, then it's pretty much confirmed in mean reversion. And what that means is that there is a higher probability that the asset will hit the mean, or the RMLR, whose third band it just hit. It will hit that RMLR before it hits that third band again. How can this be? Well, because returns mean revert. It's really just that simple. Returns mean revert, and therefore, once they stop banging away at the extreme outliers, they mean revert, because there's really nothing else they can do. It's like volatility. It can either expand or contract, right? If it's fully contracted, then all it can do is expand. If it's fully expanded, then all it can do is contract. Of course, that can take a while, because it can stay fully expanded for a while, or it can stay fully contracted for a while. But eventually, that is what will happen. So, yeah, keep that in mind. And what can I say? Happy trading. All right. Cheers.